We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money, and silverchartist.com contributor, and an expert on all things gold and silver. David, thanks for joining me today.
Oh, it's great to be with you again, Tom.
So, David, since the high in gold on May 4th, it has been more or less one-way traffic to the downside, as you recently wrote. Sentiment is in the bathroom, but it's on its way to the sewer. People are already throwing in the towel, but we haven't seen capitulation yet. So I wanted to start today by asking you, what does a real capitulation moment look like at these major lows, these major turning points in metals?
It can come in two forms. Two forms are basically, one is a high volume low with regard to price. So you see the price come down and you get a huge spike in volume at the same time. And it's the same on the upside, by the way. A blow off top is what it's called in the other direction. So you could look at JDST or JNUG or Nugget or Dust or even GDX. And when you see a big jump in volume at a certain price, and if it's going up or, well, if it's been falling and you see a huge volume at a low, you can have a fairly good degree of confidence that that's the low is in. The other version, the second one, is what we call an island candle, which basically means that it gaps down and it sits down there on its own, a little candle on the chart, whether it's green or red, by the end of the day, and then up it goes. Well, I haven't seen the island, but I am seeing the volume, and your audience can go run a chart for JDSD or JNUG or Nugget or Dust or any of those, and you saw a big spike in volume yesterday. And the other thing is that it doesn't necessarily, that volume doesn't have to be right at the bottom. It can be 2 or 3 days after, because then people have figured out, I think the bottom is in, and they're jumping in. That's where the volume's taking off. So, but I don't look at one indicator in isolation, as you know, Tom. I have a whole process. But when you get, let's switch to fundamentals for a second. What's happened in the past week? We had payrolls that came in lighter than expected. Doesn't sound like a big deal. Out of the last 14 months, there was 1 month, March, where the expectations were missed. In every single other month, we beat. That's 13 out of 14. And in March, when we missed, I think the number was, I think the expectation was 236, and we got 233. I know it was 3K below. Mm-hmm. Yeah, not really a big miss. It was like basically at the money, right? And then the next month, it was revised down to 160,000. Oh, go figure. Weird. Anyway, my point is that 13 out of the 14 months, it beat. And in March, it barely missed. So I'm trying to say that we haven't had a meltdown in employment numbers and payrolls for well over a year. And why? Well, certainly helps with rate hikes, right? And so I said going into the latest payrolls that, well, it's gone up 13 out of 14 times. The other one is basically at the money. You have to go with odds on that it's going to be higher again. Well, we got a surprise. It came in just below expectations. And that surprised the market. And what did gold and silver do? They went up. So people were getting bullish then, which is a good thing, because we're coming off extreme bearish levels in gold, especially in silver. Look at it today. Extreme bearish levels in silver, less so in gold, but not far behind. And I said, okay, yeah, don't get too excited. We've got inflation numbers next week, CPI on Wednesday and PPI on Thursday. Well, they came in low as well. And here we are. So you're asking me what's signals capitulation. I gave you the technical definition, but when you layer on the fact that we were extreme bearish and the data surprises to the upside for the metals, downside for the dollar, and then that's intermarket analysis. Look at the dollar; it's gone sub 100. And now everybody's gone from extreme bearishness. You just have to look at the silver chart today. Now they're going to extreme bullishness. I think it's going too far, too fast, and we will get some kind of pullback. But I'm not sure the bottom is in yet, because if you wanted to literally, if you wanted to crush the last week holders, the way to do it is you create a big ramp up. Everybody goes, oh yeah, and then they hammer it. They hammer it again down to a lower low, and that's when you buy it. But honestly, I don't care at this point, because unless we break 1890 in gold, I don't care if I bought it at 1920 or 1950, as long as that support holds, because the upside next is give or take 2400. Then we'll get a pullback again to probably 2000, because that's been a major pivotal point. And then 3000 next, or at least 2600, perhaps 3000. My point is the risk reward is dramatically skewed to the upside. So when you see these kind of bottoms, we'll probably get a pullback. Hopefully it's a higher low, but even if it's a lower low, unless we break 1890 in gold, I'm comfortable with my holdings that this is going to go higher. But if it goes to 1890, I probably step aside, because there could be something bigger going on at that point. But right now, everything is looking good for higher, because gold and silver couldn't get any more bearish, but you can stay bearish for quite some time. The only caveat that I have that I see, and you can see it yourself, is if you look at the COT data for gold, and you look at the banks in particular, they're still very short gold. Now, could be one explanation for this, which Ted Butler has been talking about, is that Bank of America is massively short gold, but JP Morgan is long. So you got two banks who are in polar opposite positions, and that explains the big short. It's Bank of America is that short. JP Morgan is long, but it's not as long as the short. So you got this big short. But who's the smart guy in that group? Well, JP Morgan, So I'm not going to rely on one indicator. It's just something I'm watching, and it's a caveat. But everything else is looking good.
David, part of I think the other piece of that equation around these big lows and then spikes higher, as you're talking about here, is the emotion that comes along with those movements. So is this part of why emotion is the death of wealth, as you wrote at the end of June?
Yeah, I've been saying that for quite some time, but it's hard to drum it into people's heads. Look, my process was based on going back to 2006 in every single asset, not just gold and silver, nat gas, soybeans, you name it. And what I looked for was patterns at peaks and troughs. And one of those is what you just mentioned, sentiment. Guess what happens when I'm on silverchartist.com and I'm on sproutmoney.com and I'm on these podcasts, and I try to say, and I say it on Twitter too, and it's human nature. They fight this every time. They don't fight it. It's emotion. And what I mean by this is, I'll say it simply. When we get to a low, is gold bullish at a low? No, it's extreme bearish. At a peak, is gold bearish? No, it's extreme bullish, euphoric. You have to do the opposite. Now, I don't rely just on sentiment, but it's a huge neon sign telling you, warning. And then you look at the other indicators. What are the technicals telling you? What is Elliott Wave telling you? What is the COT telling you? What is the dollar telling you? What are real rates telling you? Etc. And what are the fundamentals? What's the Fed saying? My point is that when you get to a low, when it gets bearish, that's when you start looking up. But the human nature is the opposite. They sell at the low. And it's like somebody went to school and they learned, like, buy high, sell low. That's your emotion talking. And if you can fight your emotion, well, the reason I say emotion is the death of wealth. If you can fight that emotion and say, okay, everybody's throwing in the towel, and you're looking in the mirror at yourself and like, oh, this is just hell. Now, this doesn't mean I don't believe in stops. You can stop out, but if you start to see it go back up, jump back in again. It's okay, because if you jump out and you lose a little, and you jump back in, and then you lose again, and then you lose again, and you could do that 5, 10 times, but you're losing this. And then a trend, it does finally go this way. You make that one move up and you let it ride and you bring a trailing loss along, it'll wipe out all those losses, those tiny losses. But people don't do that. They sell it and they go, throw in the towel, I'm done with it, I'm not touching it. And what happens next? When I was on Silver Chartist, they were all tearing their hair out, the subscribers there. So I posted an article to show, and I don't mind sharing it with you, Tom, where I showed all of the instances where silver was extremely bearish, and there were 12 of them. And what happened next? In one case, and it was back in the 2016 era, it went up 250%, and it was from an extreme bearish position. I said I didn't go into it because we were looking at lows. Everybody was getting upset about how it was kept falling. But there was 12 big examples of every one of these are extreme bearish, and people are throwing in the towel, give up, and what happens next? Whether it's by design or it's just the markets at work, that's the way it always is. And I'm not saying that you load up. One method that you can do is when it gets extreme bearish, you don't go, oh, it's extreme bearish, buy. Look at a previous support level that was broken. And if that level is, you break back above it, yes, you leave a few pennies on the table, but you'll have a higher degree of confidence. Oh, this thing is going north. So not only is it, extreme bearish, and now it's turning, now you get a break a resistance level, and it starts going up, much like you're seeing right now in silver. You can feel confident that this thing is going a lot higher. And with the help of people like me and some other analysts, that very few that I respect out there, telling you that this is going north. But emotion is the death of wealth, because you sell low, you give up, you walk away, and the thing takes off. And then you're at the top, you get euphoric, you come to the party late. The best example of this was .com. 1999, you had 65-year-olds buying tech stocks I had never heard of, and they got wiped out because they're buying, they see it go up. Oh, I want to get on the bandwagon. You're late to the party and you get hammered. And that's euphoria taking over. You have to use a very analytical and objective approach then, and forget. And that's the beauty of watching all these data points, focusing on data and ignoring the opinions. In fact, when I'm on Twitter and I get these people saying, "Oh, you're wrong. It's going to the moon." Oh, it's time to sell. And the same at the bottom. When they sell me, "Oh, I'm throwing in the towel, I give up." Oh, I'm buying it. Sell to me. So that's what I mean by emotion is the death of wealth. It's human nature to I give up. Those are precisely the times when it does the exact opposite.
Yeah, in that article, all those examples that you gave is on Sprott Money. We can link to
good.
that in the show notes there, because it reminded me of you saying those instances of what it did next, right?
Yes.
They're all 30, 40, 50%. And of course, the extreme example was from March 18th, 2020 at 1177. Think of how bearish everybody was at 1177. And then obviously an extreme example, but it rose 250% to 29.26 on August 10th, 2020.
Yeah, but that's why it's such a fantastic example. It got absolutely annihilated. Annihilated. And what happened next? I mean, that's the way it works. I mean, you get less dramatic ones, but take that window of that chart and look at that one. Everybody was like, I ain't touching this with a 10-foot pole. One of the biggest rallies in history, So Yeah, that's to answer your question. If you can fight human nature, fight your emotion. Emotion is the death of wealth, and look at the data, and like stand back from the crowd. And when everybody else is running into the shop to buy Krispy Kreme donuts, short of stock, and when they're like selling silver and gold like it's copper coins, I'll take it.
Mhm.
You just have to do the opposite. It makes sense, Tom, in this crazy world that doing the opposite tends to serve you better than following the herd.
Mhm.
And that can go for a bunch of things, but certainly in the markets.
Yeah, I think there's many examples that you and I have talked about, both recorded and offline as well, that I think that serves as great advice. If you think you should be going along with everybody else, maybe take a step back and question that.
Especially if they're all getting drunk at the bar and you're like, yeah, they're celebrating, they're bringing out the Chablis and all this jazz and the champagne. Oh, yeah, which yacht am I going to buy? That's when I exit the building.
Mhm.
And that's why I get that's why I get dumped on most of it, all of it, because you're ruining the party, David. What are you talking about? It's going down. What are these warnings? No, just get with the crowd, get with the program. And the same at the bottom. I think it's going, oh, you're crazy. You're nuts.
Mhm.
That's one of the foundations. The beautiful thing about sentiment in gold and silver is everybody, when we talk about the emotion as being the death of wealth, there's no greater emotion, maybe Bitcoin, than in the gold and silver markets because they've been suppressed for so long and people are so pissed off that they're so emotional about it. So, of course, sentiment is a huge factor in those sectors, less so than in stocks or boring bonds or even FX. Gold and silver, sentiment. You got to start there and then you add on the rest.
Mhm. David, I'd like to switch gears a little bit and kind of go back to the idea of the fundamentals. Why is outright deflation the biggest worry of the Fed right now? As they've been so aggressive with the rate hiking schedule that they've embarked upon.
Well, they're not. They're not concerned about outright deflation right now. They should be, but they're not. They are driving, as I posted today, looking in the rearview mirror as they're driving forward. And I say that because CPI is continuing to fall, and you saw the PPI today followed suit, falling again. And they're talking about jacking up rates another 50 basis points, 225s.
Mhm.
Huh? It's not like this fall has been new. I posted that the PPI reached a level of, I think it was, the peak was 9.2% a little over a year ago.
Mhm.
And now it's fallen to 2.4%. I said it last month it was 2.9. It got revised down to, I think, 2.6. But at that point in time, it was 2.9. That was a 67% drop in the space of a year.
Mhm.
Excuse me, how fast do you need this to drop? Imagine gold was at 2,000 and in the space of a year it's 666. How would you feel about that? Was it too slow? I mean, my point is it's idiotic, in my opinion, the argument. And I'll say that out loud because the data is telling you that it's falling and it's continuing to fall, even after you've said you want to rate, but you're still hiking rates. And you're blaming the consumer for spending. Tell the government to stop spending. Because they're the
Good
true.
luck with that.
But there you go. But they're the true source of spending, and they're not giving you this money. They're not printing this money to build manufacturing and increase farm output, yada yada. Create more hairdressers, whatever. They're handing it out to people, and goods and services are going down. The definition of inflation, mine. You can go get a textbook. You can talk to me about money, whatever his name is again, Friedman's version. Mine is simple. More money changing less goods and services, the definition of inflation, because there's more money and there's less goods. course the price is going to go up. It's economics 101. So if the government's printing money left hand over fist and has been doing so since, like anyone can remember, and the economy is going south, you're going to get inflation, stagflation. And then you get the central banks coming, oh, we need to suppress this inflation, so we're going to raise rates. What do you think that does to stocks, real estate, mortgage rates, blah, blah, blah? Mm-hmm. So on one hand, your income's able to buy less because prices are going up. And on the other hand, your assets are being devalued. Don't ask me why. I'm not going to get into that, but it speaks for itself. So unfortunately, that's the situation we're in.
So what do you see as the path forward for the Fed from here? Could we see more than a 25 basis point hike, or does it really even matter talking about because it's already being priced in by the markets?
This is where we go back to gold and silver and why I love them so much. Gold anticipated QE back in 2008 in October. QE1 didn't start till March. Gold is sniffing out that the rate hikes are already priced in. You've got the July ones already, and it's a 92% probability. And it's a long time until September. And a lot can happen between now and then. But that has I think a 12% probability of a rate hike right now. They may try to, the data may justify another rate hike, but gold and silver right now think there's nothing worse that can happen. Mm-hmm. They're either at peak hikes or there's one more. In other words, the July is priced in, and maybe we'll get one in September. And what could happen in between? What if we get a renewed banking crisis? What caused that in the first place?
Well, that's exactly where I wanted to go next. With more hikes and the lag effects, do you see more of a dramatic and widespread banking crisis as a possibility here?
I'll be very politically correct in saying this. Hell yes. Of course it is. I mean, you had 3 banks go bust because they were holding assets that were deeply underwater, but due to higher yields and higher rates on the one hand. And when wind of this got to their depositors, especially the well-heeled ones, they started pulling their money out. Mm-hmm. So they couldn't sell their assets to cover their deposits. Default, bankruptcy, insolvent. And now they're hiking rates again. And it's just a recipe for disaster. But it is interesting that it makes it easier to roll out central bank digital currencies if it's just one bank or 2 banks as opposed to 400. I'm just going to leave that there. And so, yeah, we're going to get another banking crisis. The first one was a preview. The next one is the main event. And all you have to do is look back at what happened to gold and silver when the preview occurred. They went skyward. And
which was that May high that we talked about earlier.
Yes, because the banking crisis hit in March. Mm-hmm. And from March to May, you got a nice jump. And then I think it was March 3rd. And then if you go back to November 2nd, FOMC, when Powell pivoted, in my opinion, my definition, when he said that rate hikes going forward would be lower. Look at what happened on November 3rd, the following day. Gold and silver went north. So getting back to what you said, I think gold and silver, as you can see in the charts today, are sniffing out that the worst is priced in. And even if it's not, the only thing that's left is another 25 basis points. Mm-hmm. Because if you look at PPI is unadjusted. What that means is it's not meddled with. It is what it is. Unlike the CPI, which has got hedonics and all this Mickey Mouse nonsense going on in there, the PPI is a much cleaner version. And that's just, it's going down, 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 down. And I think gold and silver have got it right, and they will continue to get it right. And look at the dollar. The dollar knows it too. So yeah, you'll get little bounces going the opposite direction in the Dixie, and you'll get the gold and silver will get pullbacks, but there's not much else. There's not much left in the ammo box for the Fed and the other central banks to raise much further, given what we're seeing in the inflation numbers. And if the employment numbers were a slight miss, if there's any degradation in those numbers going forward, it's even more of a case why the Fed's done, and that means the dollar's got problems. Now, I do think that going a quick aside on the dollar, I think the dollar, my personal target is 92. We could get a short-term bounce back up to around 101.70 to 102, and then down to 92. And that's gold and silver takes off. But then I think that the milkshake guys will get their day in the sun, and the dollar will give one last hurrah to the upside. And you'll get a pullback in gold and silver. But then I think gold and silver and the dollar go up together, because it's all the other currencies are getting devalued faster than the dollar. So the dollar goes up against them, but gold and silver go up against the dollar. So the dollar, gold, silver going up, everything else going south. That's how I see the end game playing out. The end game being for the dollar. But I think gold and silver then goes into a big pullback after the rally that started in December 2015. You will see that end in probably 2024, big pullback. But then it's going to keep going up again, because what's next? Central bank digital currencies. Central bank digital currencies will be rolled out, in my opinion, with universal basic income in order to increase in participation in central bank digital currencies. And in order to get your UBI, you will have to sign up to a digital ID. And then you get your UBI deposited in your central bank digital account. And again, like we had talked about inflation earlier and government spending, if the central banks are literally handing out money to people, universal basic income, it's not increasing production, it's not creating value. And that money is just simply spent on existing goods and services. That's inflation. The end. And if they keep doing it, and the more popular it gets, and the more people that they get to participate, the bigger the inflation. What do you think happens to gold and silver then? And unfortunately, what do you think happens to yields at that point? And what happens to the value of your house? What happens to the value of stocks? Everybody's talking about recession. Everybody's talking about a crash, and the stocks are going up, 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 up. That doesn't mean they're not going to crash. It's just that we haven't hit that point yet. So my 2 cents on all of this is that the only safe harbor, true safe harbor you have, is gold and silver. This rally is in its nascent state. And quick segue is that myself and a number of other people, such as Jeff Clark, David Morgan, and Kyle Heineman, who's the general partner, are launching the 4779 fund to take advantage of this massive bull run that we're expecting in gold and silver. I won't get into any details on that, other than to say, check out the website. And the purpose of this is to select, we're not taking a shotgun approach to buy all miners and so forth. We're only going to buy 5 to 10 and focus on those in order to create substantial returns relative to gold and silver when this bull market hits. Anyway, check it out, 4779 fund. But going back to what I was saying, that it's the only safe harbor, because Bitcoin and the crypto miners are doing extremely well right now. But I think their day in the sun ends next year with the stock market, with real estate, etc. It's a very gloomy picture. But this is all being caused by spending like drunken sailors, debasing the currencies, and unfortunately, the results of those activities are going to come home to roost in a very spectacular manner. And the only place that you should be when that happens, or at least have an insurance policy, is gold and silver. Mm-hmm. Silver even more so because it's cheaper to buy.
Right. You know, David, when we're talking about the banking crisis, that was obviously very focused in the US. Being that you and I are both Canadian, do you see the same risks to banks in Canada here?
Yes, I do, but I do want to make a comment on that. You were seeing issues in maybe smaller in other banks around the world. You saw the potential collapse of the UK gilt market, and that would have been a disaster. So you can see the cracks developing. And to answer your question, and I will be politically correct when I answer this one, yes, you can obviously see some banks here in Canada. Should I name names? I don't know. But let me put it this way, it's the too big to fail tend to get rescued, unless they want to have, which is a very high probability, all retail accounts at the Bank of Canada. Same as all retail accounts at the Fed and the ECB. But they might keep the likes of JP Morgan around in the US, and I'll say this one bank, RBC in Canada, because it's the biggest, in my opinion. And you've got some very relatively safe ones. I think CIBC is one of the most safest banks in Canada, in my opinion, based on leverage. But the rest of them, given what's happening to the housing market in Canada, I mean, the housing market in Canada has been one of the most spectacular markets in both directions in the past few years. It's got like the highest, the lowest affordability in the world, and the debt relative to personal income is off the chart, the mortgage debt. So it's a recipe for disaster. Well, who provided all those mortgages? The banks. Are they going to be rescued? I don't know. My guess is no. And I don't want to mention any names and get myself into trouble. I probably already have on this podcast. But anyway, yes, there's a lot of banks, and it's not just going to be Canada. It's going to be in Europe as well. You're going to see them dropping like flies. My guess is Deutsche Bank's going to be on the chopping block pretty soon after what happened with Credit Suisse. Mm-hmm. We just have to have another crisis, and it's not far away.
Well, you know, you mentioned the Canadian housing market and mortgages as well. With rates going up, there's variable mortgage rates in Canada that have been adding term instead of premium to the mortgages, extending some of them out to 60, 70, or even 80 years. So does this seem more like the symptoms of a system that is in its death throes? Absolutely.
Look, if we're talking about the debasement of currencies, especially the dollar, the risk that you run with, say, a bond, say a 30-year bond. Now, say it's paying you 8% yield. What is that worth to you if the dollar falls 30, 40, 50, 60%? And I'm just giving an example. I'm not saying that's going to happen. But imagine that happens around the world. People locking in mortgages 70, 80 years that they're paying on, and yet the value of the currency is dropping. When the currency drops, you get massive inflation. And yeah, you would think that, oh, that's great, value of my house is going up. Not necessarily, because what happens as well is the mortgage rate goes up. And when people can't pay their mortgage, what do? They foreclose. When properties are foreclosed upon en masse, as they were in the 1930s, and we got a taste of it in 2008 and 7, what happens to supply? What's happened to demand? Inflation. You've got less money, less income. You can't borrow from the bank. The bank won't lend to you. There's already a credit crunch. We got a banking crisis, mini banking crisis. What are the banks doing? They're tightening their belts. They're only lending to the most well-heeled borrowers out there. So you got less demand and you got potentially much more supply. And I will say that I think it was February or March, we had the biggest drop in the home prices in Canada in history. I have the chart, I can supply it. But and then in the US, we had the biggest drop in prices since 2012. So I know a lot of people don't want to hear this, but denial's not going to protect you. I'm not the only one saying this anymore. A lot of smart people are saying it. And yeah, the housing market's going to get into trouble. Stocks are going to get into trouble, aided by the banks. They're going to get into trouble. It's a pretty picture, right?
Mhm.
So say gold and silver are your insurance policy. And for those who are not as well heeled and can't afford a lot, go for silver. It'll protect you just as well as gold, perhaps even a bit more so.
Mhm. So,
And I
David,
mean physical,
Mhm.
not a certificate. Physical. Sorry, go ahead.
I was going to ask, you and I were talking a little bit before we hit record here this morning about kind of the idea that there are some people that say that the miners have underperformed their typical beta to the underlying metals here. Let's say this year, whatever time frame you want to pick. So I wanted to get your opinion on if you see it that way, and why you think that is.
Yeah, I do. I do see underperformance with respect to the miners relative to the metals. But let me say this. The miners have had a bigger appreciation in percentage terms than both the metals, especially even greater than silver. That might sound counterintuitive, but the point being made here is, although the miners are outperforming silver, which is outperforming gold, they're not outperforming to the extent you would expect them to. They're barely outperforming, or they're matching, or they're slightly above. They should be blowing the lid off. Well, there's so many things I could say here. When a rally begins, miners are usually the last to take off. The others take off ahead of it. So it's playing catch up. So that's one reason. The other reason is some of the miners in those ETFs, GDX, SILJ, and so forth, have had horrible results, and some of them are big names, and some of them have had issues with their mines in South America, potential expropriation, new regulations, and so forth. And that's put a drag on some of the miners. The other potential explanation, but I'm not seeing it right now, but at the end of the day, the miners are stocks. So they are impacted by the S&P and the NASDAQ in particular. If they underperform, then so do the miners. Now, you look at those charts and you say, yeah, they have not. The NASDAQ's done extremely well, so is the S&P, but it's all relative. How have they done relative to silver? I don't think the S&P has gone up 50% since September 1st last year. I may be wrong, but I don't think so. So that drags down the miners. But I look at the positive of all this. You're going to be able to get the miners on the cheap. Silver is taking off today, gold. And if the bottom is in and it's not confirmed yet, I'm looking for something above 2,000 gold to confirm that. As I said, 1890 to 1900 on the downside. Key level, well, the opposite direction, 2,000. If we can get back above 2,000, then I'm starting to feel very comfortable that the rally is on. But we're not there. We're not there yet. But if miners are underperforming while that's happening, you're getting them on the cheap. What are you complaining about? When gold confirms the rally, the bottom's in, and the rally is taking off, and silver then too, and you're getting miners, oh, they're underperforming. Great. I can buy more cheap, rather than the miners are running away. Oh, damn. Some people are never happy. But that's what will happen. Miners, except for some individual stocks, and those that have a higher exposure to certain South American countries right now, they are typically outperform handsomely. Now, I stock pick high beta stocks in the mining complex. I don't use GDX or SILJ. The IRS doesn't help either. They're collecting a 10% withholding from people who are non-resident in the US, and that goes for UK, Canada, Australia. So we can't touch those. So it forced me to go to individual stocks. So then I looked at the high beta ones that are consistently high beta, and I don't mean 5 years ago. That means nothing. It has to be in the last 6 months to a year, because there could be special factors that occurred years ago that no longer exist. So and I identified two in particular that stood out from all of the rest. I think it was 150 miners I looked at, and it was MUX, McEwen, and IM Gold, IAG. Since I think it was since November 3rd, they have gone up 200% into the May 4th peak, just recently. Both of them. The next best one was, I think, Kinross at 65%. It was one of those names. But those two stood head and shoulders above the rest. And now, after this pullback, they've gotten hammered. I mean, MUX, I said it was going to top out at 10, a nice round number. It did. I think it went back down to $6. I just started buying it again. That's a 40% discount. So that's the way I look at it, that I would rather be able to buy miners on the cheap than, want them to be outperforming when the bull market hasn't been confirmed yet. Because if we get the bull market confirmed in gold and silver, and GDX has been underperforming, if you're picking the right stocks, or even the GDX, and they have been underperforming, you're going to outperform gold and silver handsomely. I just like individual miners, or you can use leverage if you want. I prefer just to buy a good miner. You're going to dramatically outperform the metals. The only issue you have to worry about going down the line is nationalization or expropriation of mines.
David, what do you think the risk is of that, though?
Everything's on the table in this world. I'm not going to go into any examples, but things that we never thought would happen even 3 years ago. But if everything's going to hell in a handbasket, especially for the government finances, in order to right the ship, these guys will do anything, in my opinion. I mean, if you're suffering, Canada is a great example. If we've got massive deficits and massive debt, and we're in risk of default, one option would be to nationalize Canadian mines, because then you've got gold and silver, and that's probably taking off, and now they own it. Of course, you could have confiscate as well, but it's easier to identify the mines to take over. Mm-hmm. And depending on the government policy, or the type of government that we have, maybe they'll promote that. Oh, we should nationalize all industries, but especially gold and silver. Yeah, so anything is possible, but yeah, I think there is a very real possibility that some or many of these mines get nationalized down the line. Mm-hmm. I do. I hope not, but it is a risk. You're getting the scent of it in South America right now. They seem to be going that way. So Canada, US, definitely Australia, it's possible in all of these places. Mm-hmm.
One of the other topics I wanted to cover with you is this upcoming BRICS meeting on August the 22nd. So what do you expect to see from that? And do you think it is going to be this, sea change event like we've heard about, let's say, with the Basel III Accords, for example?
Well, there's so many options. I don't know is a nice answer here, but I'll give my opinion. I think they're going to announce something, that they're either going to do it or they're doing it. A BRICS currency ostensibly backed by gold. And for all the Twitter guys who keep saying, "Oh, they don't have the gold," yes, they do. Not officially, but the real numbers, yeah, they do. So don't rest on that one. But like with many of these announcements, Tom, and you can correct me if I'm wrong, everybody gets all balled up, and there's a lot of debate and argument and and then when it happens, hmm, nothing. It's a nothing burger, And maybe this is the same thing. It's they announce it, and nothing happens, and so we just go on as is. But it's going to happen. It's happening in the background, and it'll gather steam. But no, it isn't a nuclear bomb going off. It's like a steam engine start trying to get going on the tracks, and that's what I think is going to happen. It's going to be a dud. Now, if I'm wrong, you're going to wish you were in gold and silver at that point. That's all I'm saying. So you should. There's so many reasons why I could say you need to be in physical gold and silver. I'm not going to get into them all, but they stack up, and you need to wake up. The train is leaving the station, and I don't mean that the low is in. I'm just saying I don't care, because the risk reward is dramatically to the upside.
Mm-hmm. Do you think that if a gold-backed currency, some type of other trading currency is introduced, do you think that speeds up the timeline for, let's say, these Western countries that want to introduce a CBDC? Do you think that speeds up their timeline for them?
Not necessarily, but honestly, I never connected the two. I just know that they plan to roll out these central bank digital currencies, and I believe they're going to use UBI as a. I'm trying to stay away from the
shoehorn.
Yeah, so trying to stay away from the B or I
or a carrot. Maybe a carrot is a better.
Yes, there you go. Thank you. You saved me there. But incentive. Yep. That to get people to sign up for the digital ID and so forth that they would otherwise not do. Mm-hmm. They'll go hand in hand. But I've never tied it to the BRICS so much. So honestly, I can't answer that one. Mm-hmm. I can't.
The only reason I ask that is because, to me, if your currency is in trouble and you need to keep, let's say, faith in your currency, then I feel like that catalyst helps speed that along. That was the only reason I was kind of linking those two.
So you believe that central bank digital currencies have greater confidence than paper dollars?
That's absolutely not what I believe.
My point is, if that's their intent, it's going to fail miserably. That's why the BRICS are thinking smart about this, that if you back it with gold and or silver or other commodities, whatever, and you roll out a digital BRICS currency backed by all these things, that increases its likelihood of success. Always the issue with trying to introduce a one world currency was that you're doing it in during a crisis, but the crisis is caused by a loss of confidence in the currency. So who's going to have confidence in another paper currency or digital currency? The only way it works is if it's backed by commodities, whether it's oil, gas, farmland, wheat, gold, silver, whatever. And that's what they're doing. That's the plan. So no, I don't think that's I think the BRICS version does support the digital currency rollout there. It does not support the digital currency over here because it's not backed by anything except the full faith and credit of the government, which, if bonds are anything to go by, is going to soon be worthless. Mm. Did I say that out loud? Oops.
Well, I mean, just the idea of continuous printing, I think, leads you to that conclusion, right?
Yeah, it's digital print. It's printing, yeah. But at this point, look, if the plan is to replace paper dollars with digital dollars, what's different?
Exactly.
I
The
mean,
mechanism of control, that would be the only
yeah,
the real difference, right?
yeah, and yeah, you've got privacy with the paper and you don't with the digital. But in terms of their value, nothing.
Mhm.
They're still backed by the government, which depends on your confidence in its solvency. Uh, Whereas if you're getting a gold-backed digital currency and you can exchange it for gold, that's the key thing. They say it's gold-backed, but hey, I've got 100 central bank or 100 Fed coins. Can I take the gold? No. Well, then it starts to get dodgy because people go, well, what's this worth? Well, it's the only thing you can use. We'll see about that. There's a thing called barter. But my point is that they it certainly helps, but if you cannot actually exchange the currency for the gold, and I believe at least at the commercial level for sure, they're doing that in the BRICS. I'm not so sure here in the West,
Mhm.
and that will obviously impact its success because when they roll out this UBI, and for those who don't need it, and they can't convert it to something like gold or silver, the value of that is going to disappear like in a matter of years because it's not financing any production, so I don't think that's going to work. But if you're going to make it gold back, can I get the gold? Gold back, just saying it's gold back is not going to be sufficient, in my opinion. Okay, we'll take the gold in Fort Knox and we'll use that as backing for the currency, the new Fed coin. Okay, I'll take my coin, please.
Mhm.
Sorry, no, you're not allowed to have it. It's there, but you're not allowed to have it. Yeah, no thanks.
Mhm. Well, David, that's about all the things I wanted to touch on with you today. Is there anything else that you would like to mull over before we wrap up?
No, I think we covered basically everything. The support, key support levels and resistant levels. Sentiment is turning. Watch those shorts on on the COT data in gold. You don't have the same issue in silver. Silver, it's got a open road right now. The fundamentals, I said this a couple of weeks ago in an article, I think it's priced in. Priced in. So it doesn't matter if it gets worse if it's already priced in. Like when this rate hike comes next, a couple of weeks, doesn't mean anything. It was priced in. In fact, the dollar probably falls when the rate hike happens because priced in. And that's what gold is telling you. Gold and silver is telling you. So uh, I'll just leave on this note to say that you need to have some physical gold and silver. Physical. You can buy miners, but they're a short-term trade. You don't want to hold them for too long. I would focus on miners that have mines in North America for now. And I think this rally, we haven't got confirmation of the low in gold and silver in the metals and miners. But if we haven't, we're not far away from it, and it may be in. But my point is, don't get caught in the weeds because the risk to the downside is dramatically less than the reward to the upside. Only if we break 1890 in gold and close below there, that's when I would step aside and see what happens next. But that aside, you need to get some now because this is going to start to run away at some point.
Mhm.
And it's sooner rather than later. When the next banking crisis happens, which it will, what happened to gold and silver, just multiply that by 2, 3, 4x, because it's going to go ballistic at that point. So that's what I would leave you with. And this is a game changer. This could be life altering if you don't do it now, in my humble opinion.
Mhm.
I'm just looking out for you guys. You don't have to buy tons of it, just an insurance policy.
Mhm.
So that's where I would leave it.
Sounds good, David. Of course, you're an excellent Twitter follow, and a lot of your links and articles are all on your Twitter at Global Pro Trader. Anywhere else you want to point people to?
Yeah, silverchartist.com. I post there regularly and I post articles there. I also obviously post on sproutmoney.com too.
Mhm.
And as I said earlier, check out the fund 4779. You can see it pinned on Twitter on my account because we're launching a fund to take advantage of the rally that's coming. And just check it out. See if it's something of interest to you. And thanks again, Tom. It was always a pleasure talking to you.
Pleasure's all mine, David. Thanks so much.
Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.